Corporate debenture is simply a loan taken by a company to carry out its business. But instead of taking a loan from a bank, the company is coming to the capital markets to borrow, essentially from you and me. Companies can raise money in the capital markets in two ways. The first method we all know, this is equity. When a company goes on an IPO, it's essentially asking us to become part owners of the company. But when you invest in a debenture, you become a lender to the company or creditor of the company. So debentures, like I said, are simply loans and carry all the features of a normal loan. For example, if you think about a car loan or a housing loan, you know when you take a car loan or a housing loan, you usually pay for a 5-year period. It has a finite life. Also, we usually pay equal installments. So, part of the capital and part of the interest is paid within this installment. Similarly, debentures carry their own set of unique features. Just like a normal loan, a debenture has a finite life. To be defined as a debenture, debentures have to have a minimum life of 2 years at the time of issue. But in Sri Lanka, we've had debentures that have been issued up to a life of 10 years. Usually, you see most debentures that are issued these days are a 5-year life. Interest is also paid on these debentures because companies are borrowing from us, and companies will pay us back the borrowing in terms of the interest at a regular frequency. And generally this frequency, unlike our normal loans, is not monthly. You can have monthly interest debentures, but most debentures that we see are semi-annual frequency, annual frequency or quarterly. And in debenture terminology, we don't call this interest, we call this coupons. One more thing in debentures, just like a normal loan, we are lending to the company, we have to get our capital back. And this capital in debentures we receive at the end of its life. So in a normal loan, you'd see that part of the capital is paid back every month, for example, but in a debenture, you get it at the end of the life, and this, again, the capital value is called the face value of the debenture. Unlike a normal loan, you know, in a normal loan, when you give a loan to somebody, you have to wait for the entire period for them to pay you back. But debentures are listed in the Colombo Stock Exchange. So you can trade these debentures at the market price. You can buy debentures in the market if you want to, or sell them at a higher or lower price. Another term that we hear in the market often when we trade in debentures is what we call the yield of a debenture or the yield to maturity. This is the total return a debenture gives you when you take into account the coupons paid by the debenture as well as the capital gains. Because when I buy a debenture, I know at the end of the period I get my face value back. In between, I will get my coupon payments because the company is borrowing from me. But I might not be buying the debenture in the market at a price of 100 rupees. I might be buying it higher than 100 or lower than 100, which determines my capital gain or loss for the period. And it's important for me when I'm buying the debenture from the market to understand what is my total return, and this is what we call the yield of the debenture. So in a debenture, since we are lending to a company, it's important to assess the company's ability to pay back. We have to look at what is the probability of default, because they are taking our money and they have to pay us back within the next number of years. So we have to look at the company's profitability, the company's financial statements, the sustainability of its profitability, the amount of debt that it's taken. It's an important thing to analyze the company in depth. Another thing that we can do though is to rely on an independent agency to give us an assessment of the company, and this is what we call credit rating agencies. They give us an independent ranking of the probability of default. They would do the same assessment about the company, look at their profit and loss statement, look at their cash flows, and assess the probability of default, assess a company's ability to pay back. So a credit rating agency uses a letter designation system to show the ranking of the company and their ability to pay back. In a system that starts from A that goes down to D, the company's ability to pay back deteriorates as the alphabetical order increases. So, the best credit rating that you can have for a company is AAA. AAA indicates that the probability of default is very low. From AAA, you can go down the order to AA, single A, triple B, and so on and so forth, right all the way down to D. Generally, we define what we call investment grade companies. Investment grade means that there is very low probability of default, and investment grade is defined from triple B category onwards. The Colombo Stock Exchange dictates that at least a company should have one notch rating above triple B minus to be listed in the Colombo Stock Exchange when they are issuing debt. This is to ensure investors' safety, and mandatory ratings are required by companies who want to borrow from the stock market. But what you have to remember is this is only at the time of listing. The environment can change drastically as time goes on. Debentures are usually there for 5 years, 4 years, 10 years, and the credit rating will also change as the environment changes. Taxes can impact your credit rating, interest rates can impact the credit rating, and credit ratings by these independent agencies usually take place maybe once in a year. In between, it's up to you to be vigilant to ensure that the company is doing well and its ability to pay back has not changed. Generally, debentures are unsecured instruments, which means you have to depend on the credit quality of the company to be paid back. What that means is the company has to have good cash flows in order to pay you back at the end of its life. But sometimes companies can provide investors additional security. These are, for example, secured debentures or guaranteed debentures. Secured debentures essentially mean that the company is providing some form of collateral. In case of default, the collateral can be sold to get back the money. Or sometimes debentures can be guaranteed by a third party, again which means in case the company defaults, the third party undertakes to pay you back. These improve the credit quality of the debenture. On the other hand, you also have debentures that can be subordinated, which essentially means in the unusual case of bankruptcy, you will see that you rank last, you as an investor rank last in terms of payments. So, after all other creditors get paid, if there is money left, you will be paid. But it is not to say that you shouldn't invest in subordinated debentures, but you should realize that risk requires a higher return, and that is what investors should demand from these types of debentures. Credit rating agencies do take these into account. So, it is not simply the company rating that they will issue when the debenture is listed. They will also issue an instrument rating, taking into account the higher credit quality if the debentures are secured or guaranteed, or the lowered credit quality if the debentures are subordinated. So, when investing in stock, you are part owners of a company and you get to share in the profitability of the company. If a company does really well, they might pay you bigger and better dividends. Otherwise, this wealth or increase in profitability will be reflected by higher capital gains. Stock prices will move up. In debentures, it's slightly different. In debentures, you are a lender to a company. It doesn't matter how well the company does. Ultimately, you are only entitled to the coupon, and as far as you are concerned, you only require the company to be a going concern. As long as the company can pay you back your face value and coupon, the company's profitability is not essential. So, the single biggest thing that impacts debenture market prices really are interest rates. Generally, we say interest rates are inversely related to debenture prices. What this means is when interest rates go up, debenture prices generally tend to come down. Similarly, when interest rates come down, debenture prices tend to move up. So, for investors, when interest rates are high and they believe that interest rates are going to come down at a certain point, it's a good time to start to buy debentures. For example, think of it this way. Imagine these days, if you look at a 5-year debenture, debentures are going at around a coupon rate of 13.5%. Your fixed deposit rates are maybe 11%, 12%. Last year, if you all remember, our fixed deposit rates were around 6-7%. Today, if you buy this debenture and let's assume next year your interest rates start to come down. When interest rates come down, and let's say in the market now fixed deposits are back again down to 6-7%. At this time, you have a debenture that for the next 5 years is going to give you a 13.5% return. Now, this debenture becomes very valuable in the market, and therefore, the prices of this debenture can go up because there will be demand building up for people who want to buy this debenture that pays a 13.5% coupon. On the other hand, similarly, let's assume interest rates go up, and next year interest rates have gone up in the market, which means newer and newer companies are issuing debentures at higher coupon rates. Then the debenture that has been issued today at 13.5% is not so valuable, which means there will be no demand or lesser demand for that debenture, which means prices can come down, which is why you see debenture prices are inversely related to interest rate movements. So, the best time to buy is when interest rates are high. It's up to you to decide whether today is the right time to buy, because interest rates at the moment are higher than it was last year. If you believe that going forward interest rates will start to come down, it's time to start accumulating debentures in the market.